Hello, everybody, and welcome to our webinar. My name is Julia Plaxina. I'm a marketing manager in our Refinitiv team, and I will help today my colleagues to coordinate our Power webinar. I would like to thank you again for joining us today. So before we move to the main part of our presentation, I would like to make a few housekeeping points from my side. So if you would like to ask some quick questions, you can do this by typing your question in a Q&A box. Also, at the bottom of the webinar screen, you should see a toolbar. You can use this toolbar again to ask your questions, to arrange a number of applications such as webinar materials, technical support, or completing a survey. All applications are movable, and also you can resize each application on your screen. So as for recording, the recording of this webinar will be sent within upcoming days after this webinar. So you will get it on your email. And also, we do really value your feedback. So please complete a short survey. You can see this survey on the right screen or on the right of your screen. So actually, that is all from my side. And Eric, over to you. Thank you again for joining us today.
Okay, thank you for the introduction, Julia. So I'll just start by presenting a bit about myself first off. So my name is Eirik Thorhaug. I'm a senior analyst here at Refinitiv's Power Research Group. We're mostly working with continental power and mostly with our energy transition product, so our 2030 scenarios for power. Prior to joining Refinitiv, I studied at NTNU in Trondheim, where I studied energy and environmental engineering, where I specialized in power market analysis and power market modeling. So that's a bit about myself. The agenda for today looks like this. So first, I'll just do a brief introduction of our energy transition product, just show where you can find it, and a bit about our key objectives with creating this product, and also briefly introduce you to the long-term model itself. Next, I'll go through the model inputs to just walk you through what our assumptions are and what's the parameters that we put into the model. Then I'll go through the model outputs. What kind of outputs do we see when feeding these inputs into our model? And then lastly, I'll present some key analyses that we've made based on the outputs. So if we just start with the introduction. So why did we choose to create a long-term power market model? Well, firstly, we wanted to create a framework where we're able to quantify the effect of the rapidly changing European power sector. So as you all know, the power sector is undergoing some pretty drastic changes with the phase out of fossil fuels and the introduction of more and more renewables. So we wanted to be able to create a tool where we can try to see the impact going forward. And secondly, we wanted to run a sensitivity analysis, have the opportunity to do that. So, I mean, as we go so far into the future as 2030, there's a lot of uncertainties ahead. So we want to be able to tweak our input assumptions to see what kind of effect this has on our outputs and what our model predicts. And thirdly, we wanted to be completely transparent in all our assumptions so that you as the customer can see what we actually assume at all times. And thirdly, we wanted to share all our data with our customers, so make all the input and output data sets available to you, so that you, if you have your own models, can take the inputs that we use and try it for yourself. But also you can take the outputs and create your own analysis based on that. So where can you find this product in Icon, where you can find it under energy, power, and then continental Europe. On the top ribbon there's a tab called energy transition. If you go there, you can find all the inputs and outputs of our model, as well as the methodology behind the model itself. And all the data is displayed mostly in monthly resolution, but also in yearly. But we are going to be making the input and output data available also in hourly resolution when time further down the line. On the right-hand side, you can see the geographical scope of our model. It's currently covers the CWE area, so as well as Great Britain. So the CWE area is France, Austria, Germany, Netherlands, and Belgium. So we run this model once a month, the first Saturday every month. And so at the time of run, it takes in the most relevant, most updated prices as input data, and outputs what the model foresees. And so the latest run that we're discussing here today is from the 2nd of October, so the first Saturday of October. Just to give you guys an overview over our model framework. So our model inputs are renewable generation scenarios for all the countries in an hourly resolution. These are from our in-house models, wind and solar models. And then we also have an in-house consumption model that we feed historical weather data into to get consumption scenarios. Thirdly, we have thermal and nuclear availabilities as an input. So I'll speak a little bit more about that later on, but since it's a fundamental model, we actually model it all the way down to a unit level. So we need the availabilities as an input factor. And as we also need the cross-border transfer capacity, so we have to make assumptions regarding the build-out and refurbishments of lines between the countries that we model. And lastly, we need to input fuel and carbon prices all the way from now until 2030. I'll speak more about these model inputs as we go along the presentation here. If you move over to the model itself, it's our in-house linear programming model, which emulates the Euphemia algorithm. So the Euphemia algorithm is the algorithm that clears the day-ahead market in all over Europe. And so we clear the day-ahead market, or the day-ahead generation dispatch problem, in an hourly resolution from now until 2030. And as output from our model, we get the prices, spot prices, capture prices can also be calculated from this. We get the border flows on all borders that we model, as well as the generation mix for all hours. And since we also model it on a fundamental level with actual units, we can also calculate the CO2 emissions based on the generation from all the units in the countries. And in a similar way, we can also extract the fuel burn from this generation data. And we can do this on a fuel by fuel basis, but also on a country basis. And so I just thought I'd go a bit through the generation dispatch problem itself. I won't go too deeply into it with all the mathematical formulation and all of that. It's just to get an intuitive understanding of the problem that we're actually solving. So what we want to do is we want to find the cheapest way to cover the residual load in each individual area for each hour from now until the end of 2030. So the residual load is the demand minus the non-dispatchable generation. So that's wind, solar, and run-of-river. As this is not controllable, we subtract this from the demand, and we want to find the least costly way to cover that for all the countries. And so in order to cover this residual demand, we can use the output of conventional power units, so that's nuclear, gas, coal, lignite, etc., to cover this. And these are, of course, capped at their available capacity, which we use as an input parameter, as I mentioned before. In addition to the output of conventional power units, we also can use the flows between the areas, which is capped at the net transfer capacity on each individual border. So as we model it on a unit level, we need some marginal cost as an input parameter for each unit, as well as startup cost and the minimal stable generation of the units. So these are input parameters to the cost minimization problem. And the way that we find the area prices is that for each hour, the price is defined as the cost of generating 1 additional megawatt hour in that area. In other words, it's the marginal cost of increasing the output of the power plant that's on the margin, the marginal power producer each hour. And we solve this problem in sub-problems of 1 week. So we minimize the cost over 1 week. And then at the end of the week, we pass which units are producing into the next week. And then we do the cost minimization all over again. And we do this from now until the end of 2030. So just to understand the scale of the problem that we're solving, I've just written down some numbers here. So we solve about 81,000 hours, and we do this for 25 historical weather years. And the number of variables that we solve is roughly 850 each hour. And so if we multiply these by each other, the total number of values that we solve for is about 1.7 billion. So quite a huge problem that we're solving. And as you would expect with such a big problem, the average runtime of the model is quite big as well, about 7 hours, give or take, for each model run. So that was a bit just a brief introduction to the model framework, how it works. Next, I'll talk a little bit about the model inputs. So I'll start by looking at the plants that we use in our model. We have a very detailed internal facility database that we leverage to build a power stack for all of countries. And the way that we do this is that we have the heat rate for these plants, as well as the installed capacity and the fuel type. And with this, we can calculate the marginal cost and create it into a very granular power stack. You see here the picture. This is actually one of our applications in Icon, called the power curve, where we visualize the curve or the power stack that we use in our models. This is for Germany on the 2nd of October. We also have this for France. But as you all know, the stack is continually changing on a day-to-day basis, and even more when we go further into the future as units are commissioned and decommissioned. So when there's available information on the unit level, we incorporate this in our facility database. So as we go along, we decommission and commission these plants. And when we don't have information available on the unit level, we try to stay within the governmental targets for the coal and nuclear phaseouts, where we remove the least efficient plants first in order to be in line with the overall targets of the different countries. And speaking of coal phaseout, this is basically the coal phaseout trajectory that we are using in our model. It's largely based on the governmental targets, as I mentioned before. Obviously, Germany has a huge phase out going forward. In total, for the countries that we consider, we have about the 24 gigawatt decrease from now until the end of 2030. As you can see, Great Britain is the phase out in October 2024, and Netherlands at the start of 2030. And for Germany, we stick to the target set out by the coal phase out plan. Similarly, we have a chart here for the nuclear capacity going forward. Also here we're expected to see quite a big decrease, most of it coming before the mid of the decade. We have the German phase out, which starts already by the end of this year, and it's expected to phase out its whole nuclear fleet by end of 2022, excuse me. And then also the Belgian phase out is due to be finished by the end of 2025. So that's 8 and 6 gigawatts respectively just there. Also, we've included some decommissioning of nuclear plants in Great Britain as well. These are mainly before 2025 as well. After 2025, we see some nuclear plants coming online in Great Britain, while we have chosen to decommission a couple of units in France from 2029 as they try to become less dependent on nuclear generation going forward at the end of the decade. The only addition prior to 2026 is the Flamanville reactor in France, which we have commissioned at around mid-2023 for the time being. If we take a deeper look into the stack for or the coal or the conventional phase out for Germany, it's quite a big change going forward. Obviously, as I mentioned before, there's the hard coal and lignite phase out ongoing. For hard coal, we have this target date set by the coal phase out law. So the 1st of January 2023, there's 15 gigawatts of hard coal and 15 gigawatts of lignite coal. And in April 2030, the maximum target, or the maximum that they have targeted, is 8 gigawatts of hard coal and 9 gigawatts of lignite coal. So for hard coal, there are these coal auctions that are constantly ongoing, and for the coal auctions where we have the results, these are already implemented in our database, of course. For the future, we when the information on unit level is not known, we basically scale down between the two target dates in a linear fashion, removing the least efficient plants first. When it comes to the lignite plants, these decommissioning dates for individual units are already known, so we have implemented this in our database, and that's taken account into the model. And for nuclear, we also have the units, the decommissioning dates for the individual units. If we look a bit at the availability going forward of the plants, we can't just use the installed, the max capacity going forward. So what we do is, in the short term, we scale down the availability of the plants based on UMMs. So we scale down to account for unplanned outages. And then further out on the curve, we construct a seasonal availability profile, so which reflects the historical relationship between the installed and the available to account for these seasonal fluctuations. So as you can see in the chart here, this is for coal in Germany. There's quite a distinct seasonal pattern as we go forward. And we calculate these availability profiles for each fuel type and for each country. And you can find the country data and the fuel on a fuel basis in Icon. So you can check that out there. When it comes to our renewable energy scenarios, we have these in hourly resolution. I think that's one of the strengths of our model, is that we actually are able to capture these hourly fluctuations. And the way that we constructed our scenarios is that we have in-house fundamental models, solar and wind. And what we've basically done is we've fed 25 historical weather years, 1991 to 2015, and fed these data into our models. And from that, we have gotten capacity factors as outputs. So the capacity factors are a number between 0 and 1, which basically says something about the relationship between or the potential of generation of wind and solar in relation to the max capacity. So these capacity factors are on a country-specific basis and are available or will be made available in an hourly resolution, so that everyone can apply their own capacity build-out assumptions if they want. But we have applied our own capacity build-out assumptions for different countries, and from this we have gotten hourly wind and solar scenarios on a country basis. And these are input parameters to the model. And so here I've just plotted our wind and solar capacity assumptions for the different countries. So we basically see wind and solar doubling, or more than doubling, from now until 2030. We have done quite a lot of internal research to get to these numbers. We've largely relied on TSO reports for most of the countries. We can take Germany as an example. Here we have used the TSO forecasts, which are on a yearly basis from now until 2025. And then from 2025 until the end of 2030, we linearly scaled up the capacity so that the 2030 target that's envisioned in the Renewable Energy Sources Act is what we use in 2030. So here I'm just showing you how big of a difference the weather pattern going forward can have. This is for Germany, as you can see, for 2030. I've plotted the different. These are our most extreme cases, but if we use the wind output that we get from the historical weather year 1998 and the solar output from 2003, we see a difference of almost 60 terawatt hours in 2030 when we compare it with the wind output from 2000, with the historical weather year from 2003 and the solar output from 1998. So that's quite a big difference, and just shows how important the weather parameters are going to be as the future or in the future. Moving on to consumption. We also here have used our in-house consumption model, which accounts for holidays, weekends, and seasonality. So also here we've used historical weather years to come up with 25 different scenarios. And the demand that we use in our model is the public grid demand. So that excludes self-consumption grid losses as well as the pumped hydro. And as you can see here, we have assumed 0% growth, yearly growth from now until 2025. And this is based on the fact that we have assumed that efficiency gains will counteract the growth that's expected in the electrification of the vehicular fleet as well as the electrification in industry. But after 2025, we have assumed a 1% CAGR, so a 1% year-on-year increase all the way to 2030. As electrification takes a bigger role, and stuff like green hydrogen will become more and more prominent. Here on the left, you can see German consumption, historical and our forecast. But these assumptions are made for all the countries that we model. And obviously, this is just our base case. We will run different scenarios where we have a more aggressive consumption growth, but this is the base case that we have at the current time. If you look at our interconnector assumptions, we have mainly relied on N2E's 2020 10-year network development plan. Here you can see on the top, these are the projects that we have considered for France, or all the border projects for on the French borders. We have this for all the other countries as well. And on the right-hand side of that table, you can see the commissioning dates. And as we go along, we incorporate the NTC additions of the projects on all the borders, and you can see the results for France on the left, on the bottom left here. So you can see on each border how the NTC actually develops going forward. And then as for the fuel price assumptions, we use the Refinitiv fair value forward prices at the time of the model run. So these were the forward the prices that we used on the 2nd of October, the last model run. So the fair value prices is basically that's what we use for gas and coal, and that's basically stitching up all the forward contracts and also doing a seasonal interpolation between the contracts when necessary to account for seasonal fluctuations. For carbon, we use the forward curve, and at the end of the last traded contract, which is December 26th contract, we extend the price there until the end of 2030. And the way we do it for gas and coal price is that we extend we create a 4-year series based on 2 years of fair value prices and create a seasonal profile to the end of 2030. But also here we are going to run sensitivity analysis where we see this, and I'll speak a bit more about that later on. And those that was a brief introduction or a brief outline of the model inputs. So I'll move over to model outputs now. As I've already mentioned, I think one of our great strengths in the model is the fact that we have the possibility to model each hour going forward, and also for each weather year. So, for example, here I've plotted the German generation mix in January 2030 for weather year 1997, and you can visualize how our model sees the stack at the current time, and see for yourself if you see for yourself basically. And this can also be done for all the countries, and you can pick and choose the period that you want and which weather year you want to do it for. And another way you can visualize the generation is not looking at the whole stack or the generation mix, but look at one generation type only. So this is the gas generation in Germany for all the weather years. And as you can see, there's quite a big difference depending on the weather year that we use. Just taking January 2030 as an example, it's more than, the weather years may impact the gas generation by more than doubling, depending on the weather year. And this we have for all the fuel types and for all countries as well. And prices, you can do the same. You can, on the left, I've plotted the yearly DEA base price, all the scenarios as well as the scenario average. And I'm just pointing out here that the price spread is increasing the further out on the curve we go as the uncertainty increases. On the right-hand side, you can do the comparison. I've done the comparison between the different countries in a monthly resolution. Another interesting thing that we are able to do is to visualize the flows on each of the borders. So both on an individual border basis, but also on the net import for each country. So on the top chart here, this is the plot from Icon showing the net import in DAU from France. So on that border, you can see how it compares to the historical patterns, as well as how it is in relation to the max NTC capacities. And on the bottom chart, you can have plotted the net import in France for all the historical weather years, and you can see for yourself how much the weather years here also how much it affects the net import for a country like France going forward. The last output that I want to discuss is the emissions that our model sees. So, as I've mentioned before, the fact that we model the system in a fundamental way makes sure that we can actually extract the amount of emissions that each unit produces to cover the demand. And so here I've plotted just the stack or the different countries stacked. So as expected, the German emissions are decreasing the most, as it's already the biggest emitter, has the biggest coal stack. But also the different countries are decreasing their emissions as well. This is just for the scenario average, but this can also be done for all the scenarios. So that was a bit about the model outputs. We made some key analysis or some observations that we think is very interesting. So I'll just present some of these. So firstly, what we see is that in our model, model expects that Germany is expected to become a net importer from 2023 and onwards, following the nuclear phase out at the end of 2022. We see that the net import increases quite drastically year on year. So in 2023, our model sees about 50 terawatt hours of imports, which is in stark contrast to the historical patterns, as you can see in the graph here, where Germany has been quite a major exporter. And our model predicts that the imports to Germany are going to increase to about mid-decade before flattening out at around 90 terawatt hours in 2026 and keeping stable at this level to the end of the forecast horizon. And this we see here is the scenario average from our model. However, the historical weather years are pretty unison in this, that it will be a net importer for, or is a net importer for all our weather years. Here's another interesting observation that we made. In our scenario average, Germany wind and solar output in Germany is not expected to become larger than fossil fuel generation before 2024. As many of you might remember, we have already seen this happening in 2020, as there was a lot of demand destruction from COVID-19, and also there was a very strong renewables years with especially strong wind output. But going forward, our model sees that following the nuclear phase out with 4 gigs of nuclear capacity going offline at the end of this year, the supply deficit resulting from that has to be picked up by something, and the way the model foresees that is that it's going to be generated by fossil fuels. And you can also see going forward the solar and wind generation is expected, of course, to take over fossil fuels as the larger generation source. But in the short end, we still foresee fossil fuels dominating for some time. This is also a very interesting one. We are able to zoom in, as I shown earlier, on some extreme weather scenarios. So on the left-hand side here, we have modeled or simulated for Germany on the 24th of January 2030 with the weather year 1997. And here you see that, or our model sees that there's a large amount of flexible assets that's needed in order to cover some peak hours. So for this weather year here, we actually see there's about 11 gigawatts of flexible assets needed. So that would be batteries or new gas plants or demand-side response. And conversely, on the right-hand side, we've simulated the 28th of April 2030 with the weather year 2003. So in this case, there's just an enormous amount of wind and solar generation, so much so that it's more than what can be exported, and so that we end up with a surplus of over 19 gigawatts in some individual hours. And so what this really emphasizes is the fact that there is a huge value and importance of a flexible power system going forward. So whether it's batteries shifting the load, or demand side response coping with the shortages, or even new gas plants covering, I think the key word is flexibility, and that's what we're seeing from our simulations. And then I just want to highlight the sensitivity analysis option that we have with the current framework. So one of the sensitivity analysis that we have run is the different carbon prices. So as I've already mentioned, we use the traded forward price of carbon in our base case, but we also have a carbon price or EA price forecast from our carbon team, which you can see the comparison between the two price trajectories, and our in-house forecast is basically ending up at 90, a bit above 90 euros in 2030, and we basically put this as input parameters into our model, keeping everything else the same, and I can see the difference on our output. And so on the left-hand side here, I've plotted the difference we see in emissions in Germany. And so as you can see, just by using a different carbon price, we actually see a 12% decrease in the carbon emission from the power sector, that is. And this is the cumulative emissions from 2022 to 2030, so the overall total emission. And again, I just want to emphasize that this is just one of many sensitivity analysis that we're going to run. We're going to run for different consumption growth, more rapid coal phase out, different fuel prices, as well as a more rapid expansion of renewables. So yeah, stay tuned, and I think that's it from me. So I just wanted to say thank you to everyone, and I think we can move over to the question sessions, where I'll be joined by a couple of my colleagues, and we'll try to answer your questions as best we can. So thank you.
Okay, thanks, Eirik. My name is Petter Ager Hansen. I'm director of the Power Research team, and I will basically support Eirik in the Q&A session. We have already received quite a few questions coming in. We are trying to answer some of them individually, but I guess we can also take some of them here. I guess one of the questions that will be popping up is that the charts you show from where Germany is going to be a net importer. Where is Germany going to import from? Do you have any?
Well, it's a bit different from each year, obviously, but what we see is, at least in the long-term picture, we see it coming a lot from France. Obviously with the nuclear fleet there being quite a cheap source of generation. That's where we see it come a lot from. But actually in the short term we see France being pretty tight, so it's more in the long term that the France is exporting to Germany.
Okay, thanks. Also questions related to import. Do we think the capacity on the borders will be good enough? We have the table of basically new cables coming online. Any view on that? I guess this is a combination of what we can expect from flexible access and also other things, but do you see that that's the way of solving the problem?
The interconnectors?
Interconnectors?
I think interconnectors are going to be very important going forward. I mean, it gives a great possibility to be able to transport excess supply in one area to another. So I think the grid is maybe a bit undervalued in terms of the flexibility it provides, but definitely a very important factor going forward.
Yeah. There are also some questions around the concerns about non-predictable generation, like wind and solar, and what is going to cover for wind and solar when it's not blowing. Do you have any view on that? Is it going to still be gas plants as stays online, or the expectations around flexible assets?
I think it's difficult to say what's going to be covering that in terms of technology, but I think it's probably going to be a combination of batteries and maybe some peaking gas plants, as well as the demand side will also be very much an important factor going forward. But in terms of quantifying exactly how much will be covered by what, we've not made any analysis on that.
There's actually some questions around our assumption here. Maybe we can go back to that. Consumption. There are questions around how we have if you have included increases in transport or electrification of the other electrification on vehicles and so on. What is our approach on consumption there? Can you share a little bit around that?
It's more of a top-down approach where we've seen what the different TSOs forecast and try to stick with that. So we haven't shaped the demand in an hourly way, in a different way. We just have assumed some growth numbers based on mostly TSO forecasts and applied that to the consumption that we have. And obviously the consumption is a very big uncertainty going forward, and that's why I also mentioned that we are going to spend a lot of time on running different scenarios where we see the effect of a more rapid increase in consumption as with different assumptions regarding electrical vehicles and the electrification of the industry and so forth.
Okay, good. There's still some questions around assumptions, I guess. So the scope of the model is basically covering UK, Belgium, Netherlands, Austria, France, Germany. How do you model the basically the neighboring countries outside this?
That's a very good question. We use the fair value prices for the power price in the neighboring countries. So we use that as input in order to be able to calculate the flows between the countries that we don't model explicitly in the model. The exception is the Nordic countries, where we actually use the output of our STDP model as the prices in the Nordics.
Okay, good. Now I have an interesting question here. I think given basically we see now gas prices peaking and everything is peaking in commodities these days, and if you're going back some time back, I guess let me find the questions here. Yeah, I guess the question there is that after the start of the COVID crisis, all long-term models forecast a rise in prices until 2030 and also beyond. Now is it the opposite? Basically, prices will increase. So why this change?
I think it's a lot due to the energy complex as a whole, with gas prices being historically high and coal prices also being very high, and as well as carbon. And so when we use the forward curve as our fuel inputs, both gas and coal returns more to the mean, so it decreases quite a lot going forward, the fuel prices, and obviously that has a huge impact on the power price output as well.
Let's see. Let's go through list of questions there. So this is a long-term model, basically modeling a lot of years. So how do you modeling more like? I guess it's not minor details, but smaller parts, like you have the marginal costs for pump storage plants, for example. How do you approach this in the model?
That's a good question. We base it on a price volume regression. So basically, based on historical patterns, we basically build a price relationship for different. We include that in the stack so that it reflects the historical levels of production for each hour. So it basically what it does, it does not produce in the low priced hours, but it does produce in the high priced hours, as is the case in reality.
Also some questions that are coming in about the flow-based domain. I guess that's a tricky question. In our short-term price model, we model this in detail because we're basically receiving the parameters and so on. So what approach have we been taking for the long-term model here?
So for the long-term model, we don't use the flow-based method. We use the NTC method, which is the one they used previously, also in CWE. And the reason for this is that we don't have the flow-based parameters going far into the future. I mean, these could change massively based on the build-out of the different cables. And also it would just make the problem become a lot more complex. So for the long term, as you said, Petter, we use the NTC, and in our short term, of course, we use the flow-based method to solve to use in the day-ahead dispatch.
Good. Let's see there. we cover most of the questions. There was a question if we will include the Nordic countries in the model. I guess we, for the Nordic countries, we have a separate model called SDP, where we basically have a full optimization of reservoirs and hydro plants, which is basically the method you have to use in the Nordics. That model is doing a forecast for the next until 2025. We haven't connected these two models yet, but that's something we will try to look into, but there's nothing in the pipeline at the moment. But it's a good question, and really interesting to combine these models. I think that's basically more or less the questions. Yeah. The webinar, this can be the slides can be downloaded, will be sent out after the after this webinar, so that will be available. Anything else you want to add before we close the session, Eirik?
No, just thanks for joining, and also I would highly recommend checking out the product in Icon, so you can drill down a bit more for yourself to see all our inputs and outputs. Except for that, I don't have anything to add, I think.
Okay. Thanks, good. Thanks also for all your questions here. It's great to see so much interest for what we're doing, so thanks. Julia, some last comments from you?
I think you're muted, Julia.
Oh, apologies, I was on mute also. So I was saying that thank you very much for joining us today. Eric, thank you so much for your presentation and for your answers. Peter, thank you so much for your help with navigating with the questions. So as for recording of this webinar, as I mentioned at the beginning of our webinar, so I will send on-demand recording within upcoming 2 days. Slides will also be available in PDF, and also if you're interested in Refinitiv data, so you can now click on this pop-up screen, and my colleagues will come back to you shortly. So that is all from our side. Thank you again for joining us today, and have a lovely rest of the day. Thank you so much.
Thank you.
Yeah.